Hi, everybody. We are so excited you could join us today for the Carson Investment Research Outlook 2024 with Ryan Detrick and Sonu Varghese. Sonu, just a little bit about me, Chief Market Strategist here at the Carson Group. I've had a lot of fun. Been here almost 18 months. Time flies when you're having fun. Sonu, tell me something about you I don't know.
Oh, wow.
Put you on the spot, see? Yeah.
Yes, you did. Well, global macro strategist that you know, but one thing you may not know is, okay, I'm going to embarrass myself here.
There you go.
When I write notes and when I'm making charts and things like that, I like to listen to Euro pop, Euro dance, 90s music. Just leave it in the background. It's nonsense, complete trash music, but I like listening to it just as background music. So
you know, given some of the calls you've had this year, I think we all should listen to some of that Euro pop. That's what we're going to get into again. Everyone, again, we are really excited. We've got about 30 minutes, and believe me, if you've ever listened to Sonu and I talk, we can fill up some room. So we just need to get rolling with kind of how we see things in next year. But let's do a little bit of review, Sonu. 2023, right? It's been a great year for stocks. Bonds have done okay-ish, but we came into this year thinking stocks would do better than bonds, and we said there wouldn't be a recession this year. There's been no recession this year. You know, what I think is neat about it, though, or interesting, maybe the word to use is interesting. A year ago right now on the right, you can see kind of what the strategists were saying. The Wall Street strategists, how did they see the world? One of the first times ever, they saw stocks down in 2023. It was unanimous. There was a recession coming. The bear market wasn't over. Funny thing happened. Stocks obviously have had a really, really good year with the Dow, flirting with all-time highs. And S&P also having a good year. And then, of course, you see on the left, the next Warren Buffett. Who is it on the left there, Sonu? Remind me.
Sam something. Oh, my God. Now I'm blanking out.
Well, Sam Bankman-Fried. Well, Sam Bankman-Fried. Yeah.
Thank you. Thank you for that. But yeah, so much for that. That's all I can say.
Yes, he obviously got himself in some trouble. So again, there's a lot of different information out there and a lot of different ways you can look at the world. But on our team, we like to look at the facts, right? We like to look at the hard data. And we're going to talk about some of the kind of the reasons. I mean, so let's see what we have here. This year in general, how about you go for a second? Why did you not, and again, we don't have a ton of time, but 30 seconds or so, why did you not see recession this year when so many other people did?
I think the labor market was strong. Right. And we thought inflation would continue to come down. I think that was a big part of our thesis, if you may, our outlook 2023. And there were reasons, right? It wasn't because inflation was already trending down. We were looking ahead at what the data could possibly tell us in 2023 throughout the year. That's kind of played out, right? The labor market, as I said, employment has remained strong. Where does, the economy runs on consumption. Where does consumption come from? It comes from income, right? Where does income come from? With people getting more jobs, with people getting strong paychecks. I mean, that's continued. And I think that's why we saw economic growth run above trend this year. Forget it, recession.
What's that thing? America runs on Duncan, right? They tell us that, but apparently our economy runs on consumption.
So again, economy runs on American consumption.
That's true too. So again, this is a cool chart. I know we've shared this before. It might look familiar to some of you who've seen this before. We knew coming into this year, 2023, some of the very best quarters for stocks. If you look at a 4-year presidential cycle, were this year, right? The fourth quarter last year, the first half of this year should have been strong. Funny thing happened. It was strong for equities. Everybody was telling us the first half of this year is not going to be that great. It's the second half of the year going to do better for stocks. It's kind of interesting because almost the exact opposite happened to a degree with the first half really strong. So again, that's just something to look at. It's, Mark Twain said history doesn't repeat itself, but it often rhymes. We use that a lot. It's interesting how it worked out. Now, the other one, I'm going to skip ahead. We'll go back to that in a second. The other one that I want to build on here, Sonu, is just the idea of pre-election years. Pre-election years for the president, usually stock market does pretty good. And you can see on the screen here, the black under year 3, when you have a first-term president, Sonu, the returns are even better, up like 20% on average. Well, that's like where we are this year, right? It's amazing. And, by the way, midterm years with a first-term president, like we had last year with that vicious bear market, stocks usually don't do very well. So here's the good news for everybody listening out there. What happens next? Election years with a first-term president, you can see their returns are pretty good, up over 12% on average. But here's the kicker. The last 10 presidents, if it was their first term, last 10 presidents, the election year of a first-term president, the S&P 500 was higher 10 out of 10 times. Now, 12% on average, not wildly strong average. That's pretty good. Believe me, that's pretty good returns. I want to be clear. But still, that's pretty darn good and usually higher. And again, why is that? Well, listen, lame duck presidents, fortunately not this situation right now, 1960, 2000, 2008 were not great times for the economy and were not great times for the stock market. This isn't about blue. This isn't about red. It's about green. Washington can pull certain levers when you're up for election, potentially, to move things. And that's not just blindly why we are bullish this year. But again, it doesn't hurt our overall view. And speaking of our overall view, Sonu, what do we see for equities coming up in 2024?
I think we're somewhere in that target range, right? That I'm staring at, like
yes,
somewhere between 11 and 13%, right? And
exactly.
I have a question for you on that. Like, even going back to this year, what we saw in 2023, how surprised are you that things have played so well out to form? I know you stare at this data all the time.
Yeah, I mean, believe me, we came into this year saying between 12 and 15% for stocks with the potential for upside surprise, right? So I think I'm a little surprised we were quite this strong, but again, it was hard. A year ago, everybody was bearish. Everybody was telling you how bad everything was. Our data was saying something different. The things I looked at, things we talked about were different. But when everybody's looking at you like you're crazy, you kind of like, I'm not that crazy. Maybe my wife tells me I'm crazy, but I don't think I'm that crazy with what I'm looking at here. And then fortunately it has played out. And again, looking into next year, we still think, yeah, between 11 to 13% on stocks next year is our target. But honestly, once again, the potential for upside is there. And I'm going to go back one. Here we go. And why is that? I mean, why? Well, listen, Sonu, what usually drives bull markets? On the left, I'll give you a hint. What is it?
Profits. Profits.
Yes, it's profits. We are looking at potentially all-time high record profits next year on the S&P 500 with earnings. Again, that isn't by itself something you see in a bear market. That isn't by itself something you usually see when you're going into a recession. Now, I'll be very clear. Yes, these are estimates. Estimates can obviously change. We're aware of that. But again, it's still a positive sign. We just wrapped up another strong earnings season. We had an earnings recession. What's that? That's when earnings are down year over year. We had that for 3 straight quarters. The good news, that's in the tail. That's in the rearview mirror. We now are looking at really potentially strong earnings next year with an economy that we'll talk about soon that could surprise the upside. Also, I think it's fascinating. Margins are on the right there have actually started to go higher. Right, everybody talk about profit margins and all the issues that are there. So that's another, I guess, important thing to note with corporate America. One other one, we don't have it on the screen, but capital expenditures, capex, companies investing in themselves is also on the S&P 500 expected to hit an all-time high next year. So when you combine all those things, it doesn't smell like a recession to us. It smells like an economy that's probably going to surprise the upside. But also this bull market that we've been in for well over a year now probably has some legs. One final thing from me, Sonu. Go ahead. Anything you want to add there, Sonu, before I kind of do my final thing and hand it over to you?
No, I think with that data, even it's all looking forward, right? One thing what's happened with profit margins especially is good because what companies have done this year, and this is important for what may play out over the next, not just next year, 2024, but even beyond, they've been focused on profitability more than growth, right? They've been looking to maintain margins, increase it. There's some cost cutting, and we'll talk about the labor market. Hiring has eased a little bit. They went gangbusters, hired a ton of people, 2020, 21, even into 2022. Well, this year is about retrenching a little bit, but I think the benefits of that is going to really come in over the next year, several years, really.
No, absolutely. I think that's a good way to put it. And you think about this recession we were supposed to have that everybody talked about. Look at CEO confidence in a lot of different places. Companies were pricing in a recession, okay? I mean, they really were. So they kind of hunkered down. And in a way, I don't know if it's a self-fulfilling prophecy that we could almost avoid the recession because we were already preparing for the recession. I'm not 100% sure how that really works. But I am saying now companies are looking out to the other side. And we're going to talk about, like, the Fed is done hiking. There are some real positive things that are taking place here. That maybe you can start to see more expansion next year and more, again, companies open up the wallet books and starting to build and create and do things to increase productivity, which I know is a big theme of ours we'll talk about. There are just a lot of things out there, again, to us, that why we were optimistic this time a year ago and why we, fortunately, I think still are quite optimistic as we head into next year. Now, one final thing from me, then I'll, let Sonu kind of take the reins here. I'll chime in, I'm sure, a little bit as we go along.